Silicon Valley Bank, was it the accounting rules that were to blame? I'm Rizek, CPA certified financial planner, and I'm going to break it down for you. So, if you didn't know, in the accounting world, there's rules. Let me go and get my pocket protector before we dive in, but there's really three categories of accounting for investments, specifically debt securities. So, under ASC 320, these are the three: held to maturity, available for sale, and trading. The same bond or security that a bank holds could be classified and ultimately valued differently depending on which category or classification is used in the accounting. Let's talk about held to maturity, or HTM, first. These are going to be debt securities that the bank or institution plans to hold until maturity, ultimately until the end. You'll remember with bonds that there's a maturity, meaning that the money that you've loaned will ultimately be paid back, either with interest all at the end or oftentimes throughout a period. So bonds inside of the held to maturity bucket are amortized at cost. Ultimately, that means that regardless of what's going on in the market, only the interest income hits the income statement. There's really no adjustment in the value of the bonds, for the most part. Okay, now the second one, debt securities that are classified as trading. The intent with these types of investments is that they're going to be sold shortly. You can kind of think of it like day trading. The bank might hold on to it for a little while and then sell it. Trading securities use what's called mark-to-market accounting. Essentially, that means any changes in the value of the securities immediately hit the income statement and are reflected in the financials. There's really not a whole lot of games that can be played here. The third classification for debt securities, especially from a bank's perspective, is available for sale, and this is really kind of a catch-all. It's similar to the trading classification, except for one big thing. When the securities are marked to the current fair value, the connected accounting entry goes to other comprehensive income, an equity account, not an income statement account. It's not until the firm actually sells that security until the income shows up on the income statement, or loss in this instance. Okay, so what does that have to do with Silicon Valley Bank and the situation that they're in right now? Well, when a bank has available for sale or held to maturity investments, the losses in the value of those securities do not show up on the income statement. Now, those losses are disclosed, but they're not showing up on the income statement where most investors look first. It's not really until it hits the fan that we see it show up on that big time financial statement. Now, right now, customers of SVB, like private equity, venture capital, and startup companies, might get a little bit spooked. No, they are getting spooked, which explains kind of the run on that bank that we're seeing right now as customers are removing their deposits. Now you kind of know what's going on with Silicon Valley Bank. I'm Rizek, CPA certified financial planner. Follow me for more tips.